Well, folks, I'd like to introduce our guest today. My good friend Ryan Yates is a epic fund management expert and fund management coach, and I thought would be a perfect guest to invite on to talk about all things fund. And then this is kind of a more nuanced version of real estate investing. Not a lot of people are familiar with, and then we'll talk about funds versus syndications versus the different options you have in terms of public or private. Ryan, before we get started, thank you for joining the call and just wanted to thank you for joining us.
Well, thank you both for having me. I'm excited to see where this goes.
Absolutely. And Ryan, before we get started, where are you from in the world generally?
I'm located in Ridgewood, New Jersey. So just outside, about 15, 20 minutes outside the city.
And not too far away from Snooki and the Jersey Shore crowd, right?
Yeah, maybe an hour and a half.
Can you get me her number? No, just kidding. I don't really want I really don't. And how did you get started in your career, Ryan, before where you're working on now? How did you get started in your career?
I stumbled on it. I went to school for accounting. I started in construction, went away to college, got a job in accounting. And out of the blue, I received a call from a fund administrator called Vices back in 2007, well, maybe a little before that, 2006. And it was my first job out of college, and said, well, it looks new, alternative investing, let's see what it is. I started as a fund accountant back in 2006, lasted there till the Citigroup bought them out till about 2012, went on to Morgan Stanley. I've worked on just about every type of fund possible at this point. I work in hedge, PE, real estate, crypto, and all these new fangled ideas that are starting to pop up.
And I'm fascinated, Ryan, you got started right around the GFC. Were there any takeaways that informed your career from the GFC that you're like, oh, that's interesting? And for the record, guys, in case you don't understand what I'm talking about the global financial crisis. If throughout the podcast I say GFC, that's what I mean.
I mean, the best thing I learned was that Citi stock in your 401k could be traded on 7 days. And I made a ton of money. We had the match come in. Remember everyone when we thought the doors would be locked down, 97 cents a share? I was trading it every 7 days on my 401k. So I went from, 3 digits to about 5 in, about 6 months. It was kind of fun. But no,
it's fun when it goes that direction. Yeah, it's fun when it goes that direction, isn't it?
Yeah, and for the longest time, hedge funds were mainly liquid pools of capital. And as that hit, side pockets and all these other like nuanced parts of funds started popping up in different ways to kind of calculate and track, underperforming assets, I guess. Well, I mean, half of them were tied to Bernie Madoff at some point, but there's a lot of underperforming assets, and they started to put them into different vehicles, and just kind of, there was a lot there, and there was a lot to learn, and it was a great experience to go through. And now, as certain sectors fall off, you know what to do.
And Ryan, I think I kind of got ahead of myself. I really would be fascinated. Who are you in a nutshell? In case the people that I've had the privilege of working with you and I know you, but in case that they haven't worked with you, what would you say in a nutshell who you are?
I don't even know sometimes. No,
good answer.
Yeah, it's just I'm me. If once you get to know me, you're either a fan or you're not. I mean, most people, I hope, are fans. But I'm definitely analytical. I'm definitely accounting and operations focused. So when it comes down to processes and procedures, I'm someone to talk to. I'm a father. I'm a coach. Business guy, do just about everything. So, I have my hand somewhere.
And because this is the Real Deals Uncovered podcast, Ryan, what do you think from your perspective is the stream or the idea or the out there that most people are not aware of that comes from your perspective that's kind of flying under the radar, do you think?
In terms of
Just real estate and real estate investing, anything flying under the radar that you're like, oh, that's really interesting, or most people aren't really generally familiar with.
I mean, there's so much. There's so many numbers in there, and I think the number one thing is, numbers lie, and I'll be the first one to tell you that, being the accountant in me. Um, it's finding companies that have niches that can continue to grow. That's all it is, and that's all it's ever been. And if you look at equities, it's finding the underperforming stocks. In private equity, it's finding the company that's missing out on something that you can handle with an influx of capital. It's the same thing with real estate. I prefer ground up because there's a bigger bang for your buck in most of the cases. Some people like that stabilized income. I don't quite get it. But that's just my kind of risk tolerance now at 41 years old. And, I'm still looking to grow whatever I have. So my goal is to take chances up until I'm retiring. So it's finding and just doing the due diligence into the correct areas.
And so, Ryan, a couple of questions along those veins. What do you look for in those type of companies? Like, if there's somebody out there and they're going, hey, that's awesome. Like, what is it that you look for and you go, this is something worth me digging into more?
I mean, for me, it's track record, it's respectability in the space. It's, people have heard of you. I like these small firms, and that's usually what you have to find. But if they're working with a known builder, then you have someone who's a little more solid. You want someone who, and I've seen this before, someone who wanted to do single family homes and then go right to multifamily. He's built 3 houses his whole life, and all of a sudden he wants to build a 6 to 10 unit building. And I'm like, nah, I don't quite get it. And he's like, why? It's going to 10x exactly what I made last time. I'm like, you've never done it before. And, I come from a construction background. We did a lot of remodeling. We did roofing, we did siding, we did additions. We were not ground up builders, and we never expected to be, and we never tried to be. We fixed and flipped a couple houses, for more of an investment property, but they ended up being more of a headache because there's management. So it's finding, if you are going into stabilize, it's finding management companies that have a track record and are able to handle it. It's people who are very honest with their numbers. Like if you're at 15 to 20% vacancy, say it. Don't just put out your 5%. That's the normal 5% vacancy in your calculations, but the area has been 15 to 20% for the past 3 months. It's kind of that under promise, over deliver. You want that in your sponsors. You want that in your partners.
Mm-hmm. I love that. One of the things that we've gotten really good at saying is we're going to take everything on face value, and while we trust, we will verify. So save us a lot of time, because I don't want to find out 4 months from now that everything we base this on was bogus, because we're just going to tell you then we're not playing. And it wastes your time, it wastes my time. And it's amazing with that conversation how all of a sudden things turn around, they get real, they tell you where they're at, and then all of a sudden you can structure something that will work or not work, but then. So I love that you do that. Where is that critical place of finding somebody that's in that, where they're known and they're starting to take traction before they get so big that they may not need you? Where's that sweet spot?
I wish I knew. That's a tough one, because it's always there until it's not. And I've worked with a lot of different firms in the past couple of years, and I'm even working for a couple now where it's scaling and having the right sales and marketing team. And that's kind of the sad part, because it's kind of that trial and error stage. I think everyone does it, and I think in my post on LinkedIn today about just getting out there is kind of starting that. So if you're looking to raise, if you're staying small and you're building single family homes, you're not going to grow that much if you just build 1 home at a time, or even 3 homes at a time. But the question is, how do you get to that next level with institutional money? Well, you have to scale too. So scalability is everything. You have to be able to find those, I guess, those investment firms or construction companies that are, slowly growing and working. I want to see, definitely crawl before you walk. That's always been my thing. specific areas, because I mean, as you see, and I'm not gonna, you know, totally go negative on this, but like when Grant Cardone comes out and says, I have something in Houston, I have something in Florida, I have something in this, he's going off his name. That's perfect. But I also know that one person can't do their due diligence on every property. And, you know, being in 3 different locations, and regardless if you're building, there's 3 different rules of building. If you're running the company, there's 3 different, you know, 3 different tax codes and all this other stuff. It's all stuff that, you know, makes me question what they're doing. There are firms that'll work in one area that have built over 100 homes and it's been financing for 10 years. That's perfect. I like that idea. I like the fact that people like to stay in certain areas. At least you know for that limited amount of time, whether it's 5 years, 15 years, or 25 years, that there's proof. And then all of a sudden, you know, now you're at that institutional range because you went from, okay, you raised 5 million, you raised 10 million. All of a sudden, your next building project is $30 million. And as long as the area can sustain that, all of a sudden you can't go out to 100 investors at $100,000 each. You know, you need $20-30 million checks.
Perfect. And so if Douglas and I were in a conversation, right, and we constantly meeting new people, learning what their goals and their dreams are and all those things, what would you say your perfect customer would be, your perfect partner client, where I would just go, you need to call Ryan. He's looking for you, right? What would that be?
I mean, I'm still in that emerging manager mindset. I've always been anyone who wants to start a fund, reach out to me. I mean, I prefer people have capital, or at least a little bit, because, you know, it does take a little while to get off the ground. And, you know, having 1 or 2 projects under your belt, or 1 or 2 trades under your belt, you know, some type of track record really helps. But, you know, I'm out to help anybody, anybody who has that dream, because, you know, I think other people's money is the way to go. You know, you can only, I mean, why leverage your whole life on 3 houses when, you know, you can build 10 at a time and you have that ability to scale? And that's, you know, where I come in.
Perfect. And so we find that person, right? They have a good track record, they take care of business, they understand their area, and they're ready to move forward, you know, with their vision. We connect them with you. What happens then?
Oh, that's when the fun starts, at least for me. You know, it's getting in touch with legal, it's getting in touch with accountants and all the other fun stuff that goes along with fund management. You know, for the most part, it's pretty straightforward. I think a lot of people get overwhelmed when, you know, even 5 years ago, a fund would cost $100,000 to launch. And now if you look at syndications, you can do it for a couple thousand. You want to do, I mean, I hate saying blind pool, but that's apparently the favorite thing in real estate. But, you know, if you want to start one of those funds, it might cost closer to 20. But, you know, if you have someone like me in your corner, you have the ability to set up the infrastructure, the compliance, and the processes in place to make sure it runs smoothly. And that's kind of where I come in, because I've had a lot of people reach out over the years and they're like, well, I started this hedge fund and I'm running it, but I have no control over it. I have, you know, all these returns, but I haven't sent my investors anything. And I'm like, oh, well, you know, it's probably not in the best shape. My goal is usually to pair with third parties like fund administrators, especially in the hedge fund space. And even in the real estate space, I've really, you know, come to appreciate a good fund admin to make sure that everything's in line for your investors. I mean, you know, that's the key to everything, is making sure, especially in this day and age where, you know, you see these smaller firms, you know, go under because of debt service and all these other, one-offs where people are, you know, Ponzi schemes and all this other stuff. You kind of want to have something in place to make sure that your investors are comfortable, and it gives you a peace of mind as well. I mean, especially if you're a builder and you're raising capital, you know, you want to focus on building. You don't want to have to worry about, you know, all the investor stuff going on. It's just, there's a lot going on that my experience comes in and is able to, you know, assist you in your needs.
Mm-hmm. Love that. And so, you know, I have a lot of friends that are builders and that sort of thing. I think a lot of it's just because I wear many hats and we do a lot of different things. And so just through those relationships, but it makes me think about a number of my friends. One in particular, he always had 3 or 4, houses going all the time that were spec houses of his own. And when the market shifted and money got a little bit weird, he was like, I just don't want to put myself out there at risk. And I go, what does that mean, big picture, for your vision and what you're wanting to achieve? And he's like, I'm probably 5 years waiting, delayed. And I understood where he was because he is risk, diverse, but it's also what makes him good at what he does because he takes care of business and his money. And so I'm thinking like, okay, that's a really cool guy that has a formula that works. But the part that caused him to stall was putting all of his marbles on the table, knowing that if he got a little short in cash, it could really, there's a ripple effect. And so somebody like that, it sounded like would be a good fit for you.
Right. And I've seen it too. We actually, I wish it was a little nicer. I could show you. There's a building next door to us, and through my long lines of how many different jobs I have, I'm also the finance and compliance vice president at Appalachia Capital. And next door is a friend of our company's, and they're building an apartment building. It's supposed to be 4 stories. They're burning through their cash burn is probably about 50 grand a month right now. And it's been stalled for 3 months. And I can show you what it looks like. It's ugly, but it's things that he never anticipated. He wanted to do it all himself. He wanted to keep it in, and he didn't want to leverage. Not that leveraging is bad, but if you have investor capital, yeah, you're going to pay your investors something, but it also gives you the freedom to be able to build quicker, or the freedom to kind of weather different, hurdles that you come through. And that's part of the reason why I like handling funds and working with fund managers, because it's a little more, I don't know. I just, it's enjoyable for me because you want to see people succeed, and you want to be able to, make sure that everything's being handled right.
So Douglas, I'm sorry if I'm hogging up the questions here, but
no, it's fine. I'm enjoying it.
Okay,
no worries.
I have 1 million. I'll try to keep it to like 50,000. So Ryan, inside of that, if you like with the friend of mine that I have, and I could just count on my fingers, really quickly, some really good talented people that could use your services. How does that tie into the coaching part, right? It obviously sounds like you're also a teacher and have a teacher's heart. And, it's not like, hey, do it. And then when they leave, they're clueless on, what happens next. Tell me about the coaching part of you.
The coaching part of me, it's something that's just ingrained with me. Right now and I know Doug knows this, but, I coached football for 2 years, and then my son grew too big for that league, so I had to move to another one. So I'm coaching a whole new set of 10U kids right now. And if I can coach a 10U kid, I can coach an adult. And I know that's kind of my
kind of same
MO
thing
at this point.
Is it that much difference, really, Ryan?
There's less crying in 10U. No, but you know what? I think something that gets blown out of proportion is, the lack of support. And something I've noticed, and trust me, I can go through my whole life story. 2 years ago, I was 400 pounds and miserable working in corporate America. And here I am now. I just, people succeeding is important. And I think that, we don't help each other enough. And, the fact is, building is hard. So is investing. I think it all has that similar, and to no fault of our own, I can list books that I've read in the past 2 years that kind of explain, the reasons why we fail. And it's getting through those. And I have a lot better time telling other people what not to do than doing it myself sometimes. And, that's kind of where the coaching comes in, because I've also been through the construction process. I've seen ground up constructions. I've seen all that. And it's the same. Yeah, there's different nuances left and right, but again, it comes down to recognition and making sure that people stay on track. I know, not to out Doug, but there's times where Doug's like, well, what should I do here? And I tell him, he's like, I've been thinking that, but I never actually followed through. And that's kind of what it comes down to, is making sure that you have someone you can bounce ideas off of who is going to give you the truth. I'm not a negative person. I used to be, but I'm going to tell you if it's not a good idea. It's not, I'm not, there's no financial gain in it for me if I tell you yes or no. And that's kind of the best part about it for me.
Yeah, I completely agree. And Ryan's so good at it. Even if it is tough love, it doesn't feel harsh because of the way he delivers it. And I think that's the key of tough love at any time is how it's the delivery aspect of it. And I think that's where Ryan excels in telling you, he didn't want to say it this way, but I was basically being an idiot. And he was nice the way he said it. It was a very gentle way of saying I was being an idiot.
Well, and I think, there's a few things in that this sector of our business is there's so many unknowns around it, from people that grew up in the background of construction or grew up in other areas. It's kind of, it's this sector and then it's that sector, and people don't do what they don't know very well. And that fear holds a lot of people back that, could really be opened up if they not only had somebody that would help them do it, but then coach them on why they're doing it. And that turns into something that's pretty cool and sustainable. So I love that you're good at both of those things.
Yeah, we need it. And the funny part is, like you say, it's this sector, that sector, but it's all the same. And it's that inner voice that's telling you not to do it, or even. I mean, I have this conversation all the time with kids in college and high school where their parents just want the best for them, but they don't really know what the best is for them. They only know from their experience. And I mean, I have high school interns, college interns, and I'm like, you know what? Kind of do what you want. I'm like, you're young, you could fail. I go, I'm failing at 41. You guys could fail at 20 numerous times. I go, I took it safe, played that corporate game for a long time, realized, not that I was smarter than them, but I also had common sense. And, that kind of blew me out of the corporate world pretty quickly. And, it's just kind of applying yourself and, putting yourself out there.
So if we were sitting here 10 years from now and everything was awesome for you and your business and all of those things, what would be happening? What would you be doing? What parts do you love?
Oh, right now, I'd still be doing this business. I love this business. I love the coaching. I love the accounting part. I still love spreadsheets. I'm a spreadsheet nerd at heart. I run a 35 plus baseball team, and most people say it's just to enter the stats into the website every week. But that's not true because we're one game away from the championship, but just got delayed a week. But that's a whole nother thing. And I would really, I'm hoping to get a job coaching high school football. That's probably my goal in the next 10 years. My son is 10U. He's got about 4 years until college or until high school. So I want to be there in about 10 years because I really enjoy helping the kids. It's a lot of fun. And, I never got the chance. I played football for 2 years. I was undersized. I was in school a year early. Right now I'm 6'4", a little over that at 330, which would have been perfect for college. But in college, I think I was 6'1", 270. So I was a little shorter because I was in a year earlier. But, I'm going to relive my youth through every single kid that I can bring through a program.
That's right.
I love that. So what do you see that, from your experience in the real estate world and development and all of that, where are the gaps? Where are the places that me, you, and Douglas could help people kind of bridging gaps of the things that will help them get what they want faster?
I've got this really cool product that I just heard of, and this is it's not mine to share. Like, it's not mine, but I've spoken to this guy a few times, and Doug knows him too. I don't know if you guys heard of Build Wallet, but that's going to be pretty cool in terms of financing and keeping track of cash.
Yeah.
Especially working on these deals. And I think that's going to be a big one going forward because, there's a lot of distrust, and especially now with banks closing, investment firms, especially real estate firms that over leverage and end up going under, keeping track of cash is going to be huge, especially in the construction space. And I think, some products like that are going to be big. And of course, they're blockchain based, which is, the next new thing coming up. And, I really enjoy that space as well. Outside of that, it's transparency and communication. And that's, but that's what it is in any alternative investment. I think if I look at it, like, working for Flow Capital, having site tours on companies that are on buildings that are being built, that's huge. Getting people to come in, doing drone footage, all this other stuff. And then the next one is transparency in where you are in the process, making sure there's no delays. Communication has always been the downfall in alternative investments, especially when there's like a step removed, where if it's someone raising capital and investing with a builder, maybe the builder has something, but the investment side doesn't really disseminate the information. Having it out there for your investors on a semi-regular basis so they understand where you are and even the pitfalls. I think a lot of people don't do this, and that's kind of one thing that I like is if you're having a down month, say, if you're having trouble finding leases, stay, because you'd rather be upfront. I think you said this earlier, where you want to be open and communicative with these investors, because if not, they're going to pull their money, and then all of a sudden you're going to be in bigger trouble.
Yeah, I have a personality assessment that says that my belief is if we can talk it out, we can work it out. We got to talk it out.
And it's tough. And I know I think Doug was on the call when I said this. It was like, hard conversations are very hard to have. And as humans, you want to sugarcoat it. And as humans, you want to, make sure everyone feels good. I had to cut a 10U kid. Like, do you know how tough that is? The kid's 10. It's like, as an adult, what am I supposed to do? But, he has the ability to come back next year and try harder. But it took me a while to do it. It really did. Like, that was the first time. I mean, not to get morbid, but I've told family members that their family members are dead. And it didn't phase me one bit. But, telling a 10U kid that he couldn't play on our team, that was probably the hardest.
Yeah. Yeah. Well, Douglas, you have anything?
Yeah, I just want to back up and circle back for the folks that are not familiar with the topic or just kind of stumbled upon our podcast. What's this about? Ryan, can we walk them through the kind of the ecology of off-market and alternative investments versus the REITs? And so just so they know the big difference between, like, for example, syndication versus fund.
So, I mean, REITs are a structure that, I'm not a big fan of. I mean, we could talk about it, but it's, they're basically investment structures where 90% of the income is supposed to be distributed out to investors on an annual basis. And you'll see a lot of them on the stock market where, they have really high dividends, or it'll say 11, 12%. But there's also so many fees that can be pushed through there that, they don't have to be transparent on. When you get down to like PPMs and really look into different investments, you'll see where all the underlying fee structures are. There can be origination fees, there's sale fees, there's purchase fees. They can be taking anywhere from like 15 to 30% of your return, and you wouldn't bat an eye because you bought it at $10 a share and you're getting 10% dividends. And even if you take the reinvest and you end up with 1,000 more shares at the end of the year, what really have you gained out of it? You should have probably had double that. When it comes down to syndications and funds, it comes down to kind of your risk tolerance. I was on another podcast about this last week or the week before, where it was like, syndications are great because you can, for lack of a better term, try it out. Where if you have someone who's a syndicator and has been doing 3 or 4 deals, you can throw $50K in and say, hey, let's see what he does. A blind fund obviously has the same, if not more, due diligence, depending on how they are. Now, when I look at standalone syndications, I do about the same amount of due diligence, but your risk is a little higher because it's one building. If these people haven't built in that area, there's so many underlying factors. I mean, if you invested in the property next door to where I am right now, you'd be losing money. There'd be capital calls. There'd be all this other stuff coming in where, there's a lot of variables that you can't account for. That's why I look more, and it's not really the fund or the syndication structure, as it is the underlying companies that work on it.
Mm-hmm.
There's not many and especially in the real estate world, there's not many funds that invest in one project or one syndicator and creates like multiple transactions. There's a couple that I'm working with that are starting up that, you know, are looking to build 5 single family homes. I'm like, well, that's perfect because I need more of these in the world. So you can bet on one horse. And I hate the horse jockey trainer and all that kind of,
Yeah.
that's a very touchy subject for me. But, you know, if you're building 5 homes and you spread your risk out over 5 homes, and that's great. If you're investing in a fund where, like I said before, there's one in Texas, one in California, one in Florida, that's really risky because now you have 3 separate areas, 3 different teams, 3 different everything, and it gets very touchy. My goal is if that one syndicator was good and is doing a couple more, then I'd invest in a fund. Yeah, it's again, it comes down to risk tolerance and kind of what you're looking for. You know, funds are a good way to diversify, and they're also alternative. I mean, if you look at the whole bucket of investing, you know, any type of fund is an alternative investment. It's not really real estate. It's not really stocks. It's its own little niche. So you should still invest in your ETFs or promissory notes or all these other products out there. But alternatives should be a part of your portfolio regardless.
Very cool. Cool. If you have somebody that's just starting to get there, so I'll go back to my builders, right? And I need to connect you with some of those guys. Single family, does a handful of year, writes specs, and then he builds customs, you know, to go with that. And then also have somebody that does a lot from a multifamily standpoint, you know, I'd say 6 to 8 units, that sort of thing. Where would you recommend, like, how do you know where to recommend to them to start?
I mean, I would start with what you're comfortable with because, you know, I've been in the single, I've actually worked with a few people in the past couple of years that are in both those areas. You know, a lot of single family guys who do the custom homes make a killing, and there's no need to go any further than that. The question comes down to scalability, and then it comes down to the area, of course, because I know if you guys do, I know you guys do, but you know, finding someone to work is hard. Finding someone who actually just wants to make a paycheck these days is really hard. You know, I got a friend who owns a shop down the shore near Snooky, Bud. But you know, he's offering, you know, 401k, all this other stuff, and can't get people to work at his shop. And you know, the hours may suck, you may have to work weekends and all this other stuff, but nobody wants to work. And if you can scale your construction crew and build those single family homes and kind of take a step back and just kind of, you know, take that higher level look, you're able to grow. But if you can't find the work in the area, you know, and I'll tell you, Village J Capital, they work with one builder right now. Why? Because every other builder they've tried hasn't been able to duplicate what the first one has. And that's why you need to be able to, you know, trust. I think trust is the big issue. And, you know, you may want to go single family to multifamily. What's the benefits? Where's your, yeah, I mean, you have to make sure now it's great when you own a piece of property. That's probably the best way to do it is if you own the property and you're just building and you have that leverage to some extent. But, you know, if it depends on how it splits up in the area you're in. I mean, there's so many variables to it that it's kind of a one-to-one conversation to have to see where you want to go. You know, it's the same people that invest in treasury bonds from 35 to 65 and just retire and they're fine with their $600 draw a month. You know, that's a risk tolerance that they're ready to take. If your risk profile is a little higher, yeah, go from single family to multifamily. But make sure you have the right group with you. Now, if you need someone to kind of help flesh that out, of course, I have contacts for that. I have people, you know, I have architects, I have all these other groups that will kind of help push you in that right direction. But the question is, if your crew of 7 to 10 guys can build a house in a month or 2 months, 3 months, whatever it is, are you going to still use those 7 to 10 guys to build the multifamily? It's probably going to take you 4 times as long. And at that point, you're going to need 20 or 30 guys. And, you know, all that other business stuff that comes along with it that you really don't think about is, you know, payroll, all that other stuff has to be kind of fleshed out. And I do have a lot of the spreadsheets to prove that out because I just create spreadsheets for fun. But it comes down to, I think risk profiles number one, and then, what you have the balls to go after.
So I have another friend that kind of comes to mind. He's been a builder in the mountains for 40 years, good at getting things done. He's done, specs for himself over the years and that sort of thing. And, he's got a project right now that's an 8-plex. It's pretty cool. And he's like, I hate for me not to do it, for him not to do it. And yet his risk tolerance kind of goes into, am I extending myself too much? And the biggest part that causes him to want to do this is because it's a really good project. And he understands there's some really good money there. If I was to connect him with you, a good project, an experienced builder, gets the whole gig, can build it for 400 a foot and sell it for 900 to 1,000 a foot. How long does it take for you and him to get together? How long would it be before he would have some type of a structure? What does it cost? Right? All of those things.
I mean, if it's one structure, it can go pretty cheaply and pretty quickly. I'm booked out at least 3 to 4 hours in advance. So, that really isn't hard to get in touch with me. It may look like I'm busy, but honestly, actually, the funny part is that, the first time I've had a meeting past 5 o'clock was today. But, outside of football, which is basically from about 5:45 to 8 o'clock at night, I'm available just about any time. It's getting together a structure. If it's a standalone deal like that, you can do a series LLC pretty quickly. I mean, you can probably do it within a month if you really want to. And then it just comes down to raising capital and getting the right people in line. I can guide people in that way. You can even, pair up with someone who raises equity. Like if I knew someone like that, Doug, but it's finding the right partners. And I think that's the key in getting those conversations. I can have these conversations daily, and I have at some point, but there has to be some need on the operator's part to get it done as well. Because as much as I can make a connection, they have to be able to sell it. I mean, I have a lot of street cred, of course, and I've been around for a while now, but a lot of people still want to talk to the operator and make sure everything's running smoothly.
Yeah. And so on his part, we had a conversation about this, I think a day or so ago. He's going to miss out on the deal if he doesn't do something. And so in that scenario, and I'm glad we're getting to talk because, maybe it's somewhere along the way. And I think that's a lot of, what Douglas and I are wanting to do is just be able to bridge that gap and connect people, and so really grateful for you being on today because it gives us somebody that we could help him, help you, and everybody go in. So he ties it up, with an LOI, backs it up with a contract. What will it take him as far as cost? I mean, rough ballpark, timing, how long does it take to raise the fund so he knows when he closes? I know there's a million variables there, right? But just rough structure so I can share enough with him to get him to go, I'm going to make a phone call.
I mean, if it makes sense for a series LLC, which it kind of sounds like it does as a standalone deal to some extent, it could cost about $5,000 to get the legal documents set up and everything like that. There'd be a portal and everything kind of associated with that as well. It's low cost to run it, and depending on the build time, things like that. There is some cost to it, not much. But then it comes down to kind of the capital raising part and making sure that, it comes down to the amount. All honesty, first time coming out like this, it does take a few months to raise money. It's not going to be, someone doesn't just drop a check in your lap, unfortunately. And even, as many connections as you can have, I think everyone can attest to it's not easy to get capital right away, and especially in this space. So, I mean, you're probably looking at 3 to 6 months at least. And that's what I tell everybody, because there's a lot of people who kind of sell you down the river and be like, yeah, all you gotta do is reach out and talk to like 2 or 3 broker dealers. And all of a sudden, look, you got your capital, boom, 20 grand in a month and you're there. But what they don't tell you is you have to contact them, sign the agreement. That takes another 2 months. They have to start dripping their investors because they're doing the same things that you are. They're just being go-between, except you fronted out a lot of money that, you don't really need to spend because it all comes down to contacts and connections. If he has some people, if he has people in his network or in the relationship or even from this podcast, it could be done even shorter. But the question comes down to making sure the information gets disseminated, set up correctly, and that could take 2 to 3 weeks. That's it. I mean, they even help take care of the bank account. So 2 to 3 weeks to get up and running, depending on how the network runs, it could take 3 to 6 months. I mean, if you have friends and family, it could be shorter. If you have a rich uncle somewhere, you might not even need it. But for the most part, I can't tell you it's a fix all, but I would say probably 6 months to the end.
Perfect. And that's for here, right? Just for us to do our due diligence on something like that, in the mountains, a lot of the due diligence takes a long time. Everybody's backed up, all of those things. So the timing of that would probably work out. What would he need to have to cause the investors that you would connect him with, right? And the people that'd be interested in this, what does he need to have that would cause them to, to be interested, to lean in, to go, this is a sexy deal,
I mean, if he's been building for years, if he has that track record, that works for most of us. Depending on as long as he wasn't building mobile homes in Arkansas, I think you're good. Because again, if you're building shacks in Arkansas compared to, listen, everyone's going to take that jump, right? If you're going to take a jump into multifamily, it's a little bit of risk, but the reward is bigger. And that's all we do. And that's all we try to push ourselves, right? If you build a ranch one day and then you build a 2-family the next, look, all of a sudden you're up to multifamily with, 4 units. Yeah. So it's not, square footage. If you built one house that's 4,000 square feet, and you're building multifamily, that's 4,000 square feet. Yes, there's obviously more plumbing and more electrical work and different services and all this other stuff. But in general, as long as you can build a frame in a house and you have those connections that are able to handle the plumbing and the electrical, you're set. There's no need. One thing I would make sure, especially as you go through the kind of pitch phase, is to make sure that you understand the underlying building structures, because I do know in certain places, and I'm definitely not sure about where you guys are, but the codes are different, especially from multifamily to single family. So that's something you want to make sure that you either have a consultant or someone who knows somebody who's going to come in and watch this. Because if you go in with a single family mentality into a multifamily, you're going to end up with something wrong. And that's something that could cause them issues, delays. I think we all know that, I've seen 2 to 3 month delays easily with permits as, they come through in their inspections. And then, at least with COVID, and now, I know that's gone already, but, if there's any delay in those processes, you're blowing out another year where you're locking up people's money and their IRRs are going down. Like your 3X is great in that 18-month span, but what's 3X in 5 years? You've lost money at that point if you look at it. So, it's making sure that you have the team. And that's kind of where I come in to some extent, where you make sure that team is together. And, you may be only one person pitching to the investors, but when they say, hey, what about this? You have an answer for it. Because if you don't have an answer for it, you're not going to get it. And, I've kind of done that to many people over the past 2 years.
Yeah. Well, that's cool. And so, and that's part of what, I enjoy doing, is being able to take somebody like him and be able to bridge that gap, make sure he has the right team, make sure that he's prepared for the things that are coming. And so in that scenario, right, to what I'm hearing is, having somebody that has a good track record in the area at which they're going to be going and asking, for help in there, having a project that, has a lot of good profit in it, that everybody goes, this looks cool. And then connecting them, right, with you to be able to help with some of the infrastructure and some of those things and the connections. What else would he need on his team? What's the perfect team for him to have around him that he is more likely to win than not?
The big thing is going to be the exit plan. I think that's where it comes in, because, being a builder, you want to be able to sell or refinance, but refinancing means you're going to, carry on. Yeah, you might have a leasing agent. You can always outsource that. But when it gets down to management, so if you want to build this unit, that's great. If you just want to sell it to a management company or sell it to a group, that's perfect. Then you just have your lawyers, you have your accountants, you have, your basic package. If you want to grow and get into another area, it's going to need, your team's going to have to be bigger. I mean, the good selling point for me is, especially from the fund side, I can handle just about everything. Construction company and that is kind of run separately in most cases, where, you have that Chinese wall up where, the fund comes to here, the fund invests as a whole into this investment. So the cash leaves hand. This is where build wall will come in, because the money gets transferred to that, and then the builder is able to kind of connect everything. It's magical, especially for the investor side of things and the compliance side. Your construction company is going to be run the same exact way, except you have more freedom because you have more cash. You're not waiting on a loan. You're not waiting on this. You're not waiting on that. Kind of what you have and how you're building it out. And then it just comes, the big thing's exit strategy and making sure that you have the right team around you. Like, you have someone that can sell it. You have someone, that can lease it. And because, of course, at least in New Jersey for the most part, making sure you have, that once that first project's leased, you have someone in there to make sure you're using depreciation for your investors, because, you want that tax savings to kick in as soon as possible. And it's just, it's surrounding yourself with the right people.
Makes me think about all of the, the builders, the different investor groups and in that sort of thing that's been through the real estate cycles, right? I bought, sold, flipped 50 properties in 2005, 6, and 7, and then the market changed. There's a lot of lessons and horror stories and wins that came from that, and being able to now look at it and going, okay, been there, done that. It's different. And they're done that, but bought a lot of lessons that can be applied now. And I wonder how many builders that could use these services that have done spec houses in the good time, and then they get into times like this is where you really make the money.
Mm-hmm.
I've always been taught you make your money when you buy, not when you sell. You realize it when you sell, but you make it when you buy. And we all know right now is the time to buy, to build, to develop, right? There's so much more advantages to what you can do and keep your expenses down now than it was 2 years ago. And then there's a timing issue of when does that, right? What do you do with it coming forward? But it just makes me wonder, all of the people out there that might listen to this that goes, I've been there and done it. And if I was paired with that other part of the world that I didn't really understand, like, they could come out of this extremely wealthy. Or they could be like my builder friend that says, I don't know what I don't know. I'm just going to take my goals and dreams and just delay it by 5 years, because all I know is risking my money, and I don't want to do that right now. But his track record said he always has won. He just wins and wins and wins. But I understand, do you survive to fight another day, or do you do it different and dominate the next day?
That's
right.
That's right.
And that's your risk tolerance right there. And that's your, I hate to say that, like, your different season of your life where you are. And that's, I have a neighbor who just builds houses. He does 3 flips a year, and he's happy with that. He's comfortable, makes a good living. Could he make more? Yeah. Is he happy? That's what it is. And it's going to come down to those people that want to kind of make that change. And not to go back to it again, but Veloce Capital started, with one project for about $1 million. And, right now they're at about 150 million. And, I untold amount of buildings built because that one deal, that one warehouse was sold, turned into multifamily. And, we just closing now, I think, a 300-bedroom apartment building in Paterson, New Jersey in like 3 months. And, that's the scalability that I like. And that's kind of for me, that's kind of the bare bones track record that I look for everywhere. I want people that take risks. I'm not saying, don't go from one family to multifamily. I'm saying don't go from a single family home to a 30-unit building. Like what you were describing before, 6 to 8 units is great, because that's kind of the next logical step. You're not looking at, building a skyscraper after finishing the trailer. So,
yeah.
You have to take risks. And, I think that's something like all of our experiences are good for, is showing people the risk reward and, at least telling people, hey, people have done this before. You may feel like you're alone. You may feel like this is your decision, but that's not true. Everyone's done it. And, like my post said today, just don't be afraid to ask. Don't be afraid to speak up, because you need to be able to do that in order to grow.
Yeah, and to that end, Ryan, I'm a big believer. If you're like, say, you're making that leap from single family homes to building, a full 100-unit apartment building, what's the harm in going in and on a joint venture with someone for that first deal? And then you basically ride shotgun, and they adult supervision in the room. I hate to say it that way, but that's essentially, just to make sure you don't step on a landmine. And I'm a big believer in the joint venture idea.
And I have no idea how I became an adult in a room. I still don't feel like one, but apparently I am.
You are.
Yeah. Well, and I think there's something important in all of this to be shared, as people listen to this. One of my passions is being able to ask that question I asked you earlier, Ryan. If we're sitting here 10 years from now and everything was amazing, what would have happened? And it gives you some insight into the things that are important to people. And then one of my favorite things in the world is to help them come up with a plan and then execute the plan to get from where they are to there. And it's a blast. So I think, and then the other part, I'm really passionate about builders and developers. I grew up in a construction family. I remember my first real job, I was 11 years old, roofing houses, right? And then you evolve into everything else. But if we wasn't at school, and, that's kind of where we made our money from. And also watching at that young age, the different people that a lot of times they were the best in the business at what they did, but they didn't know how to do the other parts. And then they got stuck in a place where they couldn't be where they wanted to be in 10 years. And then they just slowly resigned to miserable, to hating everything about what they did, because they made too much money to stop doing what they did, but not enough money to bridge to where they wanted to be in 10 years. And I am super passionate with builders and developers of being able to say, how do I help you get what you want? And I think anybody that's listening to that, reaching out to one of the three of us and being able to say, that's what we love to do. And somewhere around when we're off camera, I'd love to pick your brain about how do we get you teaching high school football and everything in between.
That's right.
Cool conversation, right? What a cool testimonial to have that happen and get to be a little bitty piece of that. That's so fun. So Douglas, what here we kind of
I was just about to say we could probably record a epic 7-hour podcast, but in respect of Ryan's time, we'll go ahead and call it good for now. Ryan, thank you so much for joining us. And if somebody wants to reach out to you, what is the best way to get a hold of you?
I still think it's LinkedIn. I mean, I do have, LinkedIn is the way to go. Ryan Yates. I think it's Ryan W. Yates on Instagram or on LinkedIn. I'm on everything else, but I'm still trying to figure that stuff out. So as much as you think I have it together, I'm not the best marketer. I just kind of know what to do. I don't actually follow through, like I said earlier. But I think LinkedIn's probably the best way.
You keep doing spreadsheets, and what you do, we'll find somebody to help you with that other stuff.
Absolutely. Ryan, thank you so much for joining us.
Well, thank you, Chuck. Thank you, Doug. It was great. We can even hang up and talk for another half hour at this point and leave everyone in the dark.
We will. They'll be like, what was the after podcast? And if you pay for the special after hours podcast,
the VIP membership.
VIP membership. That's right.
That's right. You get on Patreon, and that's where you end up.
That's right.
Cool. Well, I really enjoyed it. Enjoyed getting to hear about what you're about, what you're up to, what you enjoy. It's pretty cool.
Thank you.
All right, guys, if y'all need something, let us know. Other than that, over and out.
Yeah. Good to see you, Ryan.
Good to see you guys too.
Thank you, man.
Thank you for joining the Real Deals Uncovered podcast. We'd love to hear from you about today's discussion, so go ahead and please comment in the section below. Also, don't forget to comment, like, subscribe, and share with your colleagues, because after all, sharing is caring. Also, we'd love for you to tune in next week for our next discussion on real estate and real estate investing.